These 10 charts show the main news and events of this past week. The biggest oil shock in 50 years hit the market. Gold, the 5,000-year safe haven, lost money 2 weeks in a row. The stock market had its wildest single-day swing of 2026, and one asset quietly outperformed everything by nearly 14%. If that surprises you, this video is exactly what you need. This channel exists to track where institutional money moves before the crowd sees it. We use real data, real charts, and no hype. We publish a video of the main events and news of the week every Sunday. Subscribe so you never miss one. The first main event was this. On February 28th, the United States and Iran entered active military conflict. Within days, Iran's new supreme leader announced the Strait of Hormuz, the choke point through which roughly 20% of global oil flows, would remain closed. Seaborne exports dropped 90%. The world's most important energy corridor went dark. On this chart, the x-axis runs from February 27th to March 14th. The y-axis shows Brent Crude in dollars per barrel. From $71 at war start, the orange line accelerates through 80, 90, until March 9th, when it touches an intraday high of $119.50, nearly double in less than 2 weeks. Then, March 11th, the IEA authorizes 400 million barrels of emergency reserves, the largest release in its 50-year history. More than double what they deployed when Russia invaded Ukraine. Oil still closed above $100. Every chart in this video flows from that single fact. Sunday night, March 8. Dow futures drop more than 600 points as oil hits $101. Monday opens with the S&P down 1.5%, a new 2026 low threatening to break. Then, midday, Trump tells a CBS reporter in a hallway, "The war is very complete, pretty much." The index reverses entirely, closes at 6,795, up on the day, a 975-point intraday swing on 8 words. The chart shows that full week, green line on Monday, then red all the way through Wednesday's new 2026 low at 6,672. Friday closes at 6,632. Third straight losing week, 5% off the January high. This market is not pricing earnings or rates right now. It is pricing one variable, geopolitical noise, that no model can forecast. And the fundamental picture we're about to see just made the Fed's job considerably harder. On March 13th, Friday, the BEA released January 2026 PCE data, delayed from the government shutdown. Core PCE came in at 3.1%, the highest reading since March 2024, and the Fed meets Tuesday and Wednesday this coming week. On this chart, the y-axis shows core PCE year over year. The red dashed line is the Fed's 2% target. The blue line spends all of 2025 hovering around 2.6 to 2.9. Frustrating, but stable. Then watch the final 2 points. December jumps to 3.0%. January hits 3.1%. That orange uptick. Re-acceleration confirmed. Here is Powell's trap. Oil at $100 drives inflation higher, but you cannot fight war-driven energy inflation with interest rates. A rate hike will not reopen the Strait of Hormuz, so the Fed is paralyzed. Rates hold, inflation climbs, and every investor watching this chart knows that rate cuts in 2026 are now a distant conversation. And here's the part that breaks the conventional wisdom. If inflation is rising and rates are staying high, gold should be surging. Keep that in mind. Here is what actually happened to gold. War starts February 28th. Gold opens at $5,277. Every textbook says buy. Instead, the yellow line drops to $5,085 by March 3, a 3.7% fall in 3 days. It recovers to $5,170 by March 7th, then falls again. March 14th, $5,019. 2 straight losses through an active military conflict. The blue line explains it. That is the U.S. dollar index, DXY, on the right axis. Watch it climb steadily from 100 to above 102 over the same period. Oil at $100 means inflation stays elevated. Elevated inflation means the Fed holds rates high. High rates strengthen the dollar, and a stronger dollar makes gold more expensive for every non-U.S. buyer on Earth. Demand falls, price falls. J.P. Morgan still targets 6,300 year-end. The long thesis is intact, but this week, the dollar won. And if gold, the 5,000-year safe haven, is losing a war trade, something else is filling that void. This chart indexes all 3 assets to 100 at February 28th. Orange is Bitcoin, blue is the S&P, yellow is gold. By March 13th, the S&P is down 2.9%. Gold is down 2.3%. Both underperforming. Now look at the orange line. Bitcoin drops to $66,100 on March 9th, briefly, then completely decouples. By March 13th, it is up 13.7% from its pre-war level. The same day, Treasury Secretary Bessent signals the administration is working to cap oil prices, Bitcoin hits $74,800. This is the most counterintuitive data story of the week. A non-sovereign, fixed-supply asset outperforming everything during a war, with the dollar rising and rates frozen. The institutional money flowing here is not buying a trade. It is buying an alternative to systems it no longer fully trusts. This channel tracks exactly this kind of capital movement every Sunday. And if you want to go deeper on crypto, investing, and long-term wealth building between videos, find us on social media.
Keep that plus 13.7% in mind, because someone was buying this move with conviction, and we have the SEC filing to prove it. On March 9th, the same Monday the market swung 975 points, Strategy filed an SEC 8K. They had purchased 17,994 Bitcoin at $70,946 per coin. Total, $1.28 billion. Their 11th consecutive weekly purchase. This bar chart shows the accumulation. Each bar is a checkpoint, from 190,000 BTC at end of 2023, steadily climbing until that final gold bar, March 9th, 2026. 738,731 Bitcoin. The annotation at top right says it plainly, 11th consecutive weekly purchase. That number represents 3.5% of every Bitcoin that will ever exist. One company, buying through oil shocks, rate holds, and market sell-offs, week after week. This is not allocation. This is conviction at a scale the market has never seen before. Subscribe if this is the kind of institutional data you want every Sunday before the week begins. This week, 30,000 people gathered in San Jose for GTC 2026, NVIDIA's annual AI conference. Jensen Huang's keynote is Monday morning. Confirmed announcements include a new AI agent platform called Nemo Claw, a next-generation inference chip, and $26 billion committed to open-source AI. He reportedly took a 2.5-hour autonomous drive across San Francisco in a Mercedes running NVIDIA's own system. The chart shows 6 months of NVDA price action. October 29th, that gold dot, the stock peaks at $207. Then a brutal decline to $146 by year-end, down 29%. A recovery to $193 in January, a pullback to $177, now consolidating at $180. That bracket on the left still 13% below the high. Monday's keynote either closes that gap or confirms the easy money in AI hardware is behind us. The stock is priced between those two outcomes. By Tuesday, we'll know which side won. Tesla's 2026 started as one of the S&P 500's worst stories. The Elon Musk-Doge Association triggered a consumer backlash, boycotts, vandalism, declining brand scores globally. The stock fell from its December 16 all-time high of $489 straight to a March 3 trough of $387, a 20.9% drawdown in under 3 months. Then, March 12th changed the tone. Bank of America upgraded Tesla to buy with a $460 target price. Musk publicly signaled a step back from government work. Cybercab robot taxi mass production confirmed for April. The stock reached $407, a genuine recovery attempt. But look at the final data point on this chart. March 13th closes at $391, the day after the upgrade. The gains evaporate. The BOA target implies 18% from here. The brand damage is real, and one analyst note does not fix it. Is this a turn or a relief rally into a still broken story? On March 9th, the same day oil was near $100, Bank of America's CIO published their weekly capital markets outlook. Buried inside, S&P 500 Q4 2025 earnings came in at 14.2% year-over-year growth. 5 bars on this chart. Every single one clears the yellow 10% line. 5 consecutive double-digit quarters. Analysts expected 8.3%. Final number, 14.2%, nearly double the estimate. Every other chart showed pressure. This chart shows the foundation. Corporate America is not breaking. It is outperforming, quietly. From November through February, Bitcoin ETFs bled consistently. 5 consecutive outflow weeks totaling $3.8 billion. Now look at March. 3 consecutive positive weeks. Total March, $2.1 billion. These are institutional allocations executed through SEC-regulated products in a week of $100 oil, frozen Fed policy, and 3.1% inflation. And notice that top right annotation, FOMC March 17th to 18th, GTC keynote March 16th. The 2 biggest binary catalysts of the week ahead still are to come. This is the full picture landing together, and oil shocks stress-tested every major asset class this week, and the results rewrote the textbook. Gold broke its war correlation, stocks wobbled but earnings held firm, and Bitcoin, the asset nobody had in their geopolitical hedge, won the week by 13.7%, while institutional money quietly returned through the ETF door. The question worth carrying into next week: if institutional money is flowing back into Bitcoin at $100 oil and 3.1% inflation, what does that flow look like when the pressure finally eases? This content is for informational and educational purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. If you found this content valuable, subscribe and hit the like button. Thank you for watching, and see you in the next one.